The golden era of $170 billion a day London bullion market monopoly is coming to an end. With new gold and silver marketplaces in China, Russia and India lining up to take its spot. Hello everyone. Today we will talk about gold price manipulation in context of biggest and oldest marketplace for the precious metals, London Bullion Market. We will talk how it operates, who controls it and what creates conditions allowing manipulation to exist. We will also talk about London Bullion Market Association, or LBMA for short, and its role in supporting dollar as a reserve currency. And finally, we will talk about why London Bullion Market and LBMA will lose their supremacy in the precious metal trading and will eventually be replaced by a newly developing market arrangements, putting a lot of pressure on the US dollar as a reserve currency. Let's talk. December 22, 1986. Los Angeles Times editorial. 5 London bankers meet daily in secrecy, set world gold price. London. Twice every working day, in a modern ritual, 5 bankers gather in a London boardroom and close the doors. Then they decide the world price of gold. One might think of this story as a distant past, but some of you might be surprised to find out that this scheme of gold and silver price discovery still dominates precious metal trade in London even today. Let's start with some basics. What is London Bullion Market? Here is Wikipedia article on London Bullion Market. The London Bullion Market is a wholesale over-the-counter market for the trading of gold and silver. Trading is conducted amongst members of the London Bullion Market Association or LBMA, loosely overseen by the Bank of England. Most of the members are major international banks or bullion dealers and refiners. LBMA is basically a governing organization in charge of London Bullion Market. It sets standards for tradable units, standards of conduct and acceptance criteria. Make a mental note of the fact that the biggest precious metal market in the world is loosely regulated. Any parallels to derivative markets that brought down Lehman Brothers in 2008? That mortgage security market was also loosely regulated, until crash of 2008. Just a food for thoughts. Back to the topic. Wikipedia continues. The bulk of global trading in gold and silver is conducted on the over-the-counter, OTC, market, meaning from peer-to-peer, without use of publicly regulated exchanges. London is by far the largest global center for OTC transactions, followed by New York, Zurich, and Tokyo. Gold price are set twice every business day at 10:30 a.m. and 3 p.m., London time, in United States dollars. Pricing of gold in US dollars is important for our later discussion about the dollar as a reserve currency. More on that later. Prices of gold and silver on London Bullion Market are determined by a process called gold fixing or gold fix. Here is another article from Wikipedia with a pretty good explanation of the mechanics. The London gold fixing, or gold fix, is setting of the price of gold that takes place via a dedicated conference line by 5 participating banks. The 5 participating banks are market makers. They may have gold orders on their own behalf, proprietary trading, their clients' behalf, brokerage, or frequently some of each. The lead participant will begin the fixing process by proposing a price near the current gold spot price. The participants then simulate the result of trading at that price. Basically, price fix would be determined by moving price up or down until all orders are satisfied. At that time, price would be published as a set price for the day. Now, this Wikipedia article lists 5 banks as the market makers. This was a historic number going back almost 100 years ago. Currently, fix is determined by 14 market makers listed as follows. Interesting fact to note is presence of Chinese government entities. I recently did a video about extent of Chinese influence on international capital markets. You can use a link here if you are curious. I will also post it in the description below. So despite all the technological advances, prices are still set the way they were set for 100 years, basically manually. There are reasons for this, and we will talk about that. Main rationale for existing LBMA trading process is confidentiality. And this is the core of manipulation scheme on London Bullion Market. This lack of transparency and manual setting of the price of gold and silver is not an accident, it's by design. It allows central banks and biggest players, like sovereign funds and big banks, to control the market. Let me explain. First off, the fixed system of price discovery is opaque. Regulated exchanges, like COMEX and such, have a record of all transactions and order books is visible to millions of the participants. Under LBMA trading practices, trades are done bilaterally, with only 2 directly involved parties coming to an agreement, without any reporting requirements. Justification for fixed system is that this small group of participants and the lack of transparency allows to protect identity of buyer and seller. This, allegedly, helps to maintain stability of the market. The argument is that if a central bank is buying or selling, that might move the market. Well, this argument doesn't really hold any validity. Stock markets has been dealing with this issue for as long as they existed. There are models to distribute order flow to obscure large orders and such. But given the fact that the London bullion market is loosely regulated and there are only 14 market makers, I would suggest that the reason for the secrecy and concentration of power is a simple desire to control the market by creating conditions for colluding. Coming to an agreement by 14 parties that have common vested interests is much easier than an agreement by a million of participants. Remember what happened during the recent nickel market blow-up? Nickel prices exploded, causing massive losses for shorts and shut down LME. What was the LME response? They simply reversed the trades. Reuters reported. The nickel trading debacle is the biggest crisis to hit the world's oldest metals forum in decades. Suspension of trading on March 8 left consumers and producers without key benchmark prices and damaged the 145-year-old LME's reputation. I would agree this small club called LBMA is designed to avoid just such situations. But another side of this coin is ability to manipulate prices in the direction those 14 find agreeable. Second reason I believe the system was designed for gold price manipulation is commingling of physical bullion and derivatives. When market makers introduce their orders, they do not differentiate between actual gold in the vault and derivatives. Enter fractional gold banking. Same idea as fractional fiat system. Market makers can hypothetically create an unlimited amount of paper long or short orders to suppress or support the price by submitting it along with the rest of the physical orders. And since the bulk of trade is done with unallocated gold, and with backing of the Bank of England in case there is shortage at LBMA vaults, scheme works perfectly. Say you have to support the current price level of gold. You simply add some paper long positions, and the market will move upwards. This is a simplification, but it demonstrates the point. I will release a more detailed video describing this scheme in a few days. For now, I would just quote Wikipedia again. Unallocated accounts. Unallocated accounts represent the most popular way of trading gold, silver, platinum and palladium on London Bullion Market. Transactions may be settled by credits or debits to the account while the balance represents the indebtedness between the two parties. Credit balances on the account do not entitle the creditor to specific bars of gold or silver or plates or ingots of platinum or palladium but are backed by the general stock of the precious metal dealer with whom the account is held. The client in this scenario is an unsecured creditor. Unallocated risks. While members of the LBMA provide no information on the backing for unallocated gold, the improbably high turnover is suggestive they are operating a fractional reserve system where unallocated accounts are only partially backed by physical gold. Similarly to a bank run, this makes LBMA unallocated gold accounts susceptible to loss if a sufficient number of market participants request delivery of physical bullion. So as we can see, lack of oversight, almost unlimited resources and complete lack of transparency provide fertile grounds for market manipulation. Again, I do not think this is a design flaw. It's too apparent for that. UK and US both have very strict security laws to specifically prevent market manipulations. I would argue London bullion market was designed the way it was designed to manipulate precious metal pricing. Central banks have a track records of gold price manipulation. If you are curious, you can research London gold pool from 60s, when the cartel of 8 central banks attempted to control price of gold at $35 per ounce. All of the above gives me a reason to believe that central banks are behind the current reincarnation of the gold price manipulation machine. Regarding the fate of LBMA and the dominance of the London bullion market. LBMA is basically a cartel formed by an exclusive group of 14 players. The reason London became the center and in fact a near monopoly of gold trading for the best part of the last century lies with the history of British Empire. Biggest producers at a time were British colonies and London was a financial center of the empire. It had the most advanced financial infrastructure, was a major geopolitical center and was the obvious choice at the time. Today, London no longer controls any of its former gold-producing colonies. It has no mining, refining or any other gold production-related industry other than vaulting. With the rise of the multipolar world, both militarily and financially, many countries no longer need LBMA as an intermediary. Some can choose to engage in bilateral trade, some can establish their own trading platforms. Let's take a quick look at latest developments. China is the biggest gold producer in the world. They are net buyers of gold internationally and operate a major commodity exchange within its borders. Eventually, majority of trade by China most likely will shift away from overseas and towards domestic marketplace. Latest news show that Russia is planning to launch its own metal exchange called Moscow World Standard. Russia is one of the major precious metal producers in the world, second only to China, so delegating control over one of its major commodities to a risky counterparty might not be in Russia's best interests. Besides, Russia was bitterly complaining about price rigging by LBMA. According to official news from its Ministry of Finance, Russia is planning to invite few other gold-producing countries to form its own gold trading cartel that would control around 62% of the world gold production. And I really doubt gold will be priced in dollars on that marketplace. India is a major consumer of gold and silver and was making headlines recently with its own plans to establish a regional precious metal exchange. Since the confiscation of the Venezuelan gold reserves by the Central Bank of England, I do think Caracas might choose Russia or China as its gold distribution route. South Africa has always been a major producer of gold but had some domestic issues lately, so it affected its gold output. I didn't see any news about its own trading platform, but South Africa is one of the founding members of BRICS, so we can deduce its allegiances from this fact. So as we can see, the need in London as center of the gold trade is slowly but surely diminishes. And as I mentioned at the beginning, gold trading in London is done in US dollars. Given the enormous daily trading volumes generated within London Bullion Market, loss of substantial market share to other regional exchanges will lead to a major drop in demand for US dollar. As the trends towards de-dollarization continues, I have no doubts that Russia, China, India and others will choose their own sovereign currencies over US dollar. No one can see future. Will the center of gold trade shift to China? Or Singapore? Or Russia? I can't tell, we will see. One thing is clear. Old cartels that no longer control actual production will become obsolete. This was true for oil and other commodities, it will be true for gold. It's not a question of if, it's a question of when. Thank you for watching, please subscribe and like if you would like to see more on this and related topics. Until next time.